Let me play out a common scenario for you. Your favorite stock YouTuber just released a video an hour ago. You're one of the first people to watch it, and he's mentioning a $1 stock. Now you're all hyped up and you're ready to jump in on it. But then you realize it's at $4. In today's video, I'm going to teach you how exactly you can avoid that. Because if you give a man to fish, he eats it for a day. But if you teach a man to fish, he eats forever. Let's go. What's up, guys? Welcome back to Curb Code. Today's video is a really important one because what's been happening in the market recently is not normal. This is not supposed to be happening, and that just highlights some issues that we have in today's market. And one of which is these low price stocks are being majorly manipulated by Twitter, YouTube, Reddit, any type of social media. That's a problem. There's going to be changes. It's not going to be the way it has been, especially for you new guys, in the market. And what we need to do after everything just settles down is we need to get back to the basics. We need to start from square one and just learn the fundamentals. How do you pick a good stock? Now, I mentioned in the last video that I only buy dividend stocks, and that's for two major reasons. One, passive income. This is money that you get no matter what the price does. It could go up or down, and you don't need to work for it. And it's just steady, dependable income. And another would be it's not as influenced by the market or social media, these stocks. These are big blue chip companies that are not as affected by this. How do you go about finding these types of stocks? That's what I'm going to show you. But listen, if you just want to be spoon-fed the answers, this video is not for you. You get caught cheating in school, your grade suffers. If you get caught cheating in the stock market, sooner or later, it's going to catch up to you and your wallet will suffer. So if you want to genuinely learn how to pick a good stock, you're in the right place. Okay, guys, first and foremost, we need to find stocks to evaluate. So I'm here at Yahoo Finance, and I'm going to go to screeners. And what this is it's basically just a big funnel, and you start out with a bunch of stocks and you narrow down the competition based on certain criteria that you get to pick. So I'm going to make a screener here, and I'm going to add some filters. All right, let's add some filters. Price really isn't important to me right now. Region, we'll keep that in the United States. Debt to equity. So this is a big criteria that I have, that it's less than 30%. And what this means is that a company, has funding, and it's made up of debt, but it's also made up of their own money. And when you have less debt, that's always better, because you could always think about it this way too. It's hard to go bankrupt if you don't owe anyone any money. So debt to equity, we want that less than 30%. And my other big criteria here is dividend yield. This is the amount that the stock will pay you back just for holding on to the stock as a percentage of the price. So we'll close that out. Sector, let's add technology. That's always a good industry to be invested in. And debt to equity, as I said, less than 30. Dividend yield, normally I look between 3 and 4, so I'll put that down. And the reason why is if a stock's yield is too high, they won't be able to afford to pay that dividend. It's always harder to pay a bigger dividend, and we want this stock to be able to increase their dividend over time. So let's find some stocks. And as you see, that went from 6,000 to 6 real fast. And that makes our life so much easier, because now we only have to spend time on 6 different stocks. Let's pick one though. HP, I'm sure many of you guys have HP computers, so we'll look at their stock. And I just look at the summary. Over here, forward dividend and yield, that's the amount per share that they'll give you, 78 cents. You could also think about it this way. For every $100, they'll give you $3.12. $3.12. Jeez. And how much are they earning? $2 per share. So, they got some room to increase this dividend. Price to earnings ratio around 12. That's right around where I like it. How much are they earning? Their price divided by that. So you want that to be as low as possible. Let's go to statistics. All right. Now this is a big number here too. Price to sales. They are selling more than what they're valued at. This means that they're undervalued. Anytime you see price to sales below 1, that's a good sign. Okay, so let's keep scrolling down. Payout ratio, big number. This is the amount of their earnings that's allocated to paying dividends. Between 30 and 60, that's a good number because it shows that the company is dedicated to paying dividends, but it also shows that it has room to increase them. Whenever the payout ratio is around 70%, they really don't have that much room for error. You never want to put it in if it's above 100. That's a huge red flag right there that they're about to cut the dividend. And so that's basically all I look at other than return on equity, but we'll have to calculate that a different way. We'll move on to analysis. We want to know that their earnings will grow over time. Basically what we're doing here is we're making sure this company can afford to pay their dividends right now. They can afford to pay them whenever they have a bad quarter, and we want to know if they can increase them. So those are our big 3 questions that we got to ask ourselves here, and we'll go and look at their growth estimates. Over the past 5 years, it wasn't looking too good. A negative 8% increase. They decreased their operations by 8% each year over the past 5 years. There is a light at the end of the tunnel, though. They're looking to do 10% each year for the next 5 years. That's not bad. That's a light at the end of the tunnel. So we'll look into that some more. Earnings history here. This is what they have done compared to what they were expected to do. And you see 20%, 15%, 14%. What does this mean? It means that they earned more than what they were expected to. This is each quarter over 2020. So they did a really good year this past year. Hopefully they can keep that up and they'll increase this dividend here by a good amount. We also need to look at their financials. I'm going to take all of these numbers here and plug them into my Excel spreadsheet. And big numbers here, we're looking at their operating income, interest expense, a bunch of other things. But primarily we're just looking at the income statement and the balance sheet. That's where we get all of our information for the Excel spreadsheet. Historical data, we're also going to import some numbers from here over the last 10 years. So we'll do 2010. Done. Historical prices, each month we'll apply that, and we're going to download an Excel spreadsheet that we could transfer into mine. Let's open that up. All right, my computer is freaking out on me here. Okay, cool. So all of the price history over the last 10 years of every month. We're also going to do that for dividends here. I'm going to skip this step because this is the most time-consuming step out of all of them. We're going to skip ahead here to the future. I punched in all these numbers here. I imported my data down here. Everything is done here. Everything is done, and we can just look at the stock. How safe is this dividend? It looks pretty safe to me. Payout ratio around 38% according to this. Interest coverage, not bad. What this means is they can afford to pay their loans, the interest on their loans, 15 times with the profit that they're making before they have to take out any more money to pay their dividends. Their shareholders will not suffer if they take a hit in profit. That's nice. Durability, you got to look, does this company have a sustainable competitive advantage? It is pretty tough to get into the tech industry here. And we're going to look at other things too. Long story short, I wouldn't buy this stock for $24, what it's currently at. I would for 16 though. It does show, it's a safe dividend. There is room for improvement. And over the last year, they have been hitting their earnings goals. But over the last 5 years, they don't have momentum in increasing this dividend. We want to buy stocks that will increase the dividend year over year by a bigger amount each year. And they haven't been doing that. It's been about the same every year for the past 10 years. We want stocks with momentum. Once again, we have to ask ourselves these questions here. Is this a safe dividend and will it grow? After that, we got to ask ourselves, for this price, is this a good deal? And right now, it's not. You might be asking why and how I got these numbers here. This is my secret weapon. This is my Bible, the Ultimate Dividend Playbook. I also read Dividends Don't Lie. That's definitely a good read there. But this is why I made this spreadsheet, so you guys don't have to read those books. If you have any questions about any stock on the market, I could easily run it real quick. You just gotta let me know in the comments below. But after all, guys, our main mission here is to help you guys. Once again, any questions, leave them in the comments. Everyone's been getting caught up in these short-term gains lately, and this is for the long term. This is the stuff that's going to help you retire. It's stress-free knowing that you're putting your money into financially secure institutions rather than trendy stocks that could take a turn at any moment. At the end of the day, as long as we helped just one person take their finances seriously and send them in the right direction, that is all that matters to us. 1 subscriber, 1,000, whatever, we don't care. We are here for you. Thanks again for tuning in. I hope to see you guys in the next video. And as always, have a great rest of your day.